afternoon, and welcome to the final session of day one of the Growthpoint Investor Showcase. This session will cover one of Growthpoint's fund management businesses, Lango, which is strategically focused in Africa. It will be presented by Thomas Riley, the MD, will give us an update on the business, followed by a Q&A session. Just some housekeeping issues before we begin. Nothing new to all, but please remain on mute and ensure your video feed is off. The Q&A, as you know, also will be at the end, and you can post your questions using the chat box function, raise your hand function, or ask me directly via email. And with that, I hand over to you, Thomas. You may begin.
Thanks, Nazim. Thanks for the intro, and thanks everyone for joining us today. I know it's lunchtime in South Africa, so hopefully we don't interrupt that too much. But anyway, without further ado, obviously, as Nazim said, I'm the managing director of Lango. It's a business which Growthpoint, is a shareholder in, and something which we founded as a collective approximately 3 odd years ago. And I'll take you through some of the brief history and who the parties are that are involved in the business, and then through to the current state of the business and some of the opportunities that we're looking forward to. So just in kicking off then, just as a brief introduction, as I mentioned, we kicked the business off 3 odd years ago, about 3.5 years ago, and at that stage it was a joint venture between 91, which then was Investec Asset Management, and Growthpoint Properties, together with the IFC. So essentially through them we have the World Bank involved in the business as a shareholder, and the business has grown substantially since then, and we'll take you through essentially what we do, right? So Lango, first and foremost, if we look at the bright orange heading at the top here, this is really a succinct statement as to what we do, really. So it's a real estate company at the end of the day. I mean, we often loosely refer to it as a fund, but at the end of the day, it is a real estate company which really aims to generate sustainable and compelling, in our view, investor returns. So that really speaks to the fact that we're not a development company. We don't look at developing real estate. It's really akin to a REIT. So we look at producing income for our shareholders on a sustainable basis, and every 6 monthly we pay dividends. And then through the acquisition of prime commercial real estate. So I think what's important to note here is that the business, first and foremost, is extremely focused, right? So we're a real estate company, but with a very specific focus on the commercial real estate market, so retail and office predominantly, and to the extent that we can find prime logistics assets, we'll look at those. But it's really focused on those sectors. So we're not into residential real estate, we're not into student housing, we're not into hospitality or anything of the sort. So Lango is very focused on the commercial side of the real estate sector, and in key gateway cities, right? So we're looking at predominantly the main capital cities, which are akin to being gateways in our view into the real estate, into the African continent per se. So the major commercial hubs, if one likes, within Africa. So you're unlikely to ever find Lango investing into a secondary city or an outlying area or something of the sort. We're very much focused on getting the prime assets in nodes which are undoubtedly the key nodes, or the key gateway nodes as we call them, throughout the continent. So the business really focuses on generating income out of our real estate investments. We had a first close back in 2018 of $212 million. That was the first amount of capital that we raised into the business. Growthpoint at that point in time injected $50 million of that $212 million. And we started off then with 5 shareholders. The latest NAV of the company has now grown to in excess of $321 million. And we have total assets on the balance sheets in excess of $600 million. So in rands, for most of you, obviously that's circa 10 billion rand of assets on the balance sheet. Where is the business going? Well, essentially what we're looking to do is raise a total of approximately $750 million. That was a targeted, size of the business that we had set at inception. And at that point in time, the business will pursue and has committed to pursue an IPO. So we will be a separate listed real estate company, and that focus is on a listing on the London Stock Exchange at that point in time. So the opportunity set on the right-hand side, we believe there's potential for compelling and sustainable, for that matter, long-term returns in Africa. I think we're all too aware of the broader risks of investing into Africa, but we believe that from an income generation perspective, from investing in prime real estate assets, and along with the underpin from the demographic trends. I mean, there are a few countries globally which are growing at this point in time that match some of the key nodes in Africa. Obviously, there are a lot of places in Africa that we wouldn't invest into, and we're very selective in that regard. So the cities that we do focus on, we believe, provide us with a really compelling investment case. The current market conditions as well, I think if one looks at how COVID has impacted the markets over the last year or so, last 18 months for that matter, Africa has not been impacted to the extent that the developed world, or South Africa for that matter, has been impacted. If I look at our collection rate of actual rental collections based on billable income over the last year, for the financial year 2021, we collected close to 99% of our billable income for that year, and year to date, we're about to release our results for our half year, but suffice to say that our rental collections are actually slightly in excess of that. So it's a really positive story in terms of our performance through this. Many of the countries that we invested in didn't have a single day of lockdown. So Africa has largely just carried on, where a lot of the other countries that many of us will be more familiar with perhaps have had a different experience. I think the whole socioeconomic and the impact story is something, the third last bullet point there is something that we really are starting to articulate. I think as we get closer to an IPO in the next sort of 3 to 4 years, articulating an impact story and the attraction of impact-driven capital is something that we are really focusing on. And I think that is something which is garnering increased attention at a rapid rate, and something that could potentially lead to driving a premium as and when we list. Right, so I think obviously this presentation will be shared after the fact. So I think if I move a little quicker now, obviously from a socio-economic impact, there's a strong impact story essentially that we're articulating that will drive capital growth into the business as far as we're concerned. The investment strategy I've already articulated. I mean, it's all about key cities, and it's about accessing long-term rental and sustainable rental growth from top-tier tenants. So we have tenants of the likes of the big banks, Stanbic Bank, First National Bank, Standard Chartered Bank, are all major tenants of ours in these various countries, along with the likes of companies like Google. So we recently signed Google as their West African head office in Accra. So that's to a large extent the type of tenants. So it's high quality income producing assets, conservative gearing as well, or moderate gearing in the region of 30 to 40% is what we target. So there is a leverage effect from gearing, and we actually recently concluded a significant debt transaction, the largest on the continent, interestingly enough, a $300 million debt deal, which basically sets the business up to leverage its returns, and at the end of the day, look to provide an income return in the region of 5 to 8% per annum. So we pay distributions to our shareholders in the form of a dividend every 6 months, and a total return, obviously because the assets are levered, between 13 and 16%. And ultimately, on the right-hand side at the bottom there, the listing is targeted to take place in the London Stock Exchange in the next 3 to 4 years. The investor base, as I mentioned, We had a limited investor base when we first started out 3.5 odd years ago. That has since grown to in excess of 20 investors, and the bulk of these investors are like-minded in the sense that they're typically large institutional or sovereign wealth investors, and many of them pension funds actually from the institutional side. So it's long-term money, it's like-minded money, stable money if one looks at it from that perspective. And we're expecting good support from those investors, given the type of investors that they are, as we look to grow the business. Just some history in terms of our performance over time. So going back to when we originally started the company, made the first acquisitions of the business, the growth has been significant. One can see the NAV there. We haven't really posted the value of the assets. Obviously, that has been quite significant, but comes through in the NAV per share. So if you look through March 20 to March 21. Managed to maintain a NAV per share or share price which actually increased through the period. I don't think there are too many businesses that managed to do that through the COVID period. And I think maintaining a collection rate of close to 99% of what we build is part of the underpin of that story. So something we're quite proud of. Right, if we look at the portfolio overview and just where we mandated to invest, I think, first and foremost, obviously, Africa is a large place, right? We're a large continent, and you can't paint, the continent with a single brush. They're very bespoke ways of doing business in some of these countries. Some of the laws are not conducive, in our view, to be commercially investable. Some of the countries from a real estate perspective, to be honest, haven't really developed to that level where we are comfortable that there's a suitable supply of stock and that it has effective risk mitigants to invest into, such as title certainty, that one has an effective deeds registry and the like. So the countries that we actually will focus on and are mandated to invest in is quite limited. At this point in time, we're invested in 4 countries. And predominantly in 3 of them. So Angola is listed there as a invested country, but we really just inherited a few tracts of vacant land there. The bulk of the investments are in Ghana at this point in time, and we have residual investments in Nigeria and Zambia. The rest of the countries are really there in mandated form, so we're able to invest into them. But at this point in time, we're pretty focused on investments potentially into Kenya. Outside of that, the rest of the mandated countries will probably remain as mandated, not invested for the medium term. Right, in terms of the current asset portfolio, you can there see on the right-hand side where we have the bar charts, $621 million of assets under management. The growth has been quite significant, and we'll take you through the portfolio in a moment, but I think it's suffice to say that we probably and arguably have the best real estate portfolio in terms of prime assets in the commercial space in Africa. I don't think that's really contested. We have really built a fabulous business over the last 3 years, and it's underpinned by really great assets. So $620 odd million of assets. We have an average yield, and this is all in dollars, so an average yield of 9% on the portfolio. Loan to value slightly higher than we'd like. It's sitting at 45 odd %, and the reason for that, we're actually going through a current raising of capital at the moment, and that's really just to reduce certain amounts of debt that we had in the business, which was really used as a bridge to equity to acquire some of the assets. So we really funded some of the acquisitions through slightly higher levels of debt, and we're now looking to repay that debt through equity. And I'll give you some more detail on that in a moment. Average contractual escalations, very similar to the way it works in South Africa, as many of you will be familiar. It's a contractual annual increase in the income profile of our assets, averaging around about 3%. And again, that's in dollars, so well above US inflation. Right, on the left-hand side, you can see the allocation to various countries, 47% in Ghana, so almost half the business is currently located in Ghana, and that's stood us in really good stead. I mean, Ghana is one of the shining lights on the continent from a governance perspective, from a performance perspective. You know, growth in the order of 6 or 7% of GDP. It really is outperforming to a large extent. Zambia, Nigeria, I mean, Zambia this year has at the highest or the best performing currency of all time. We did struggle in sort of the last 1 to 2 years, but that really has come good of late. So a lot of positive movements in that country as well. And as you can see at the bottom, overweight in office. So office and retail is the bulk of our investments. A small piece of land as well that we have, but generally driven by office and prime offices at that, with typically blue chip international tenants as our tenant base. And this next slide speaks exactly to that. So 82% of our tenant base are global and multinational tenants. Average or weighted average lease expiry of about 4.3 years, so fairly long leases on average. And 97% of our income profile is dollar denominated. So worth seeing that. Right. Just moving on then to some of our assets, just to give you a feel. Sometimes a picture, as they famously say, says 1,000 words. So this is one of the assets, Standard Chartered building. Goes to say it's a Standard Chartered head office. It's also now occupied by Google. So we have Standard Chartered and Google, and of late, Newmont Mining as well, one of the largest gold mining companies globally, occupy that asset, key asset in Ghana. Achimota Retail Center, an example of one of our shopping centers in Ghana. Most of the shopping centers that we have out of interest are smaller assets. We found that in Africa, the smaller assets tend to perform better. We have less market risk in terms of being overcapitalized in terms of a specific node, and the performance generally has been the way to go. Manda Hill contradicts that to an extent. This is arguably one of the most mature though, and really one of the first formal retail centers outside of South Africa that operated in the rest of Africa. It's in Lusaka, in the capital, and really is one of the dominant retail assets in the region. Stanbic Heights, again, Stanbic head office, so obviously division of Standard Bank. Themselves, SAP and Samsung are also tenants in that building, along with General Electric. So one gets a feeling for the type of tenants that populate these assets, and you can see, I mean, clearly top class assets. Again, Accra Financial Center, which is really First National Bank's head office, along with the African Development Bank. That's also in Accra. Junction Shopping Center, another retail asset that we have in that part of the world. The Wings, this is this building, out of interest, would not be out of place in the City of London or in Sandton for that matter. It is absolutely P-grade assets, as top class assets as one would get in that city. So, and again, occupied by the likes of RMB, Sasol, Oando, etc. Circle Mall, again, another small retail asset that we own. Right, just in the interest of time, then, just kicking off with some of the initiatives that we're currently busy with. I think worth mentioning, as I'd spoken to or alluded to earlier, that we're currently raising capital at the moment to effectively as a bridge to the previous equity that we needed to employ, and repaying some of the debt. We're currently raising $175 million. So there's a second fundraising period, so to speak, as we've called it. That's currently being raised. We're very advanced in terms of that process. So that's going to take the total projected capital base to circa $500 million, and effectively gives us firepower for additional assets, which we expect to take our asset portfolio to roughly $800 to $900 million worth of assets. So significant business that's being able to be grown here. And I think if we look at an IPO over the next sort of 3 to 4 years, purely through accretive growth without any further capital, we're going to get pretty close to our $750 million worth of capital that we had targeted to, and in order to complete the IPO on the London Stock Exchange. So that's more or less where we are. What are we going to do with some of the new capital that we're raising? First of all, we've allocated or earmarked $50 million of the 175 to debt. So that's going to take our LTV down to sub 40%, around about 38.9% to be more precise, LTV, which we're quite comfortable with, and that works for us in terms of our debt structures, our covenants, and I think for the sustainability of the business puts us in a very strong position. The balance of the capital is to be deployed into a new pipeline. So we are looking at certain transactions in Kenya specifically, and more specifically in Nairobi. Again, similar assets to the ilk that you've seen in the presentation to date. So really strong assets, very strong in terms of quality, and we don't expect that to dilute the quality of the portfolio at all. If anything, what it does is it's going to add to the diversification of the business. I think Kenya brings certain diversification benefits in the sense that it has different underlying macro drivers to the commodity-based West African countries. This is much more service-driven, it's much more financially driven. And Nairobi, arguably outside of Johannesburg, is probably the next or the most important financial center on the continent. So we expect to add that to create a significant diversification benefit through that. And I think suffice to say that, at this point in time, I guess as it is in SA to an extent, but it really is quite pronounced in the rest of Africa, to the extent that one has dry powder in the form of surplus capital, your ability to drive growth and to do a compelling transaction or accretive acquisition transactions in the space is very strong. So we'll be in a very strong position to be able to create further benefit to our shareholders and drive growth. Right, so in summary, we obviously believe there's a compelling opportunity in the space, but also a compelling opportunity in our business. So we're looking forward to having investors coming through and supporting our second fundraising period. The business is highly focused. We're a highly focused team at the end of the day, and we're scalable. So we are at the end of the day, a REIT-like structure. We are a company which will go public. Pipeline is very strong. We have a strong management team, strong partners, strong support from our stakeholders, which includes the likes of 91 Growthpoint, the World Bank via the IFC, and other significant institutions. As I said, a very like-minded investor base at this point in time. And we're looking to broaden that investor base as we near the IPO. Clearly one needs a diversified investor base to a far greater degree once we do list. But that will come over time, obviously. From a return perspective, obviously I mentioned the targeted returns. Clearly, I think from our perspective, we're hoping to outperform those as we get closer. And clearly, as we get closer to the IPO again, I think to the extent that we have enough scale, first of all, because obviously at IPOing, one needs a degree of liquidity, one needs a scale that backs that up. But also to the extent that we can deliver an attractive yield to our investors, first of all, and secondly, to the extent that we can garner support from the impact community. I think impact investing to a large extent, particularly in Africa, and to the extent that one has an attractive impact story and a narrative in that regard, puts us in a strong position to be able to attract capital from that market. So we're expecting some exciting times ahead of us. I think we've managed to put together a fabulous business, good team, good support, and the market is there. I mean, often it's all about timing, as one says, as opposed to time in the markets. And I think our timing here in terms of acquiring the assets that we have in the past, being able to manage them to the extent that we have, but also looking to deploy new capital and dry powder, so to speak, into, really acquisition of assets and potentially at significant discounts, we believe is going to stand us in good stead. So I think that really is all I had to say. Obviously, this presentation will be shared with you after this, and hopefully that's all from my side. I think that I had to say. So Nazim, I think I'll take questions then if there are any questions from the audience.
All right, so just a quick reminder to the participants, if you'd like to ask a question, you can post them in the chat function, raise your hand, you can ask directly or email me. I've received a few emails and WhatsApps already, and I've posted those questions in as well. I suggest maybe we just run through them one by one. The first question, what is the fund's dividend policy and how much is retained on an annual basis?
Right, yeah, thanks for that. So the fund's policy is pretty straightforward. So we've basically structured ourselves in terms of look and feel as a REIT. So REIT legislation doesn't really exist in widespread form across the African continent, but nonetheless we've structured ourselves in that way. And that means essentially that dividends are paid 6 monthly, first of all, and we pay out a minimum of 90% of our income that's generated at that point in time. So very much akin to what you would see in terms of REIT-like distributions globally.
Can I maybe just add to this question? Is what is the tax expense? How do you manage the tax leakage? Is it through various transfer pricing and shareholder loans? Maybe you can run through that.
Yeah. So I mean, obviously we have I guess we like to call it a tree structure in terms of the way we're structured. So we have various in-country holding entities which own the assets, and then above that we are structured in Mauritius. So we have various holding entities that in turn own those assets in Mauritius, and an ultimate holding entity which is Mauritian domiciled. So the reality of it is that in country we typically pay very little tax. It's part and parcel of the reason why we gear our assets. Aside from the leverage benefit that we get, the debt also allows us to write off interest against income generated to an extent, and then obviously we're able to depreciate the assets. So from a tax perspective, there's very little tax that's paid in country. The bulk of the income that gets generated gets pushed to Mauritius, and we pay a net of 3% tax in Mauritius. So it's an efficient structure from that perspective. And effectively, if one looks at leakage, I guess, Nazim, one's looking at the 3%. That's largely the leakage. It's pretty limited.
Perfect. A question from Ridwan at Nedbank. Can you share timelines on the potential BEE transaction for 10% of the Manco? Can you provide details on pricing and structuring of the deal?
Yeah, hi Ridwan. So in terms of a BEE transaction, obviously I'm subject to some degree of confidentialities on this deal, but the party that's involved in that has signed a term sheet. We're in the final stages of agreeing execution documentation, and we expect that deal should be completed, at least signed, in terms of the necessary documentation by the end of this month. And that transaction then completing as soon as the necessary approvals have taken place. So there's likely that there may be some exchange control approvals that are required for that. In terms of pricing, the transaction has largely been concluded on the current value of the management entity. There has been there was contractually a formula-driven pricing that had been agreed on that deal. So, but it largely reflects the value of the assets or of the management company at that point in time. In terms of structuring, very straightforward. It's been a simple sale of shares. So the management entity of Lango is a Guernsey domiciled entity, so it's not a South African entity again, and that will simply be selling the shares in question.
I've got a question from Paulo. Could you talk to us to the valuation policy? How often is the portfolio valued? and what portion of the assets are valued externally each time?
Sure. Thanks, Paulo. In terms of valuation policy, assets are valued externally 100% of the time. So we always use independent valuers for the portfolio. And in terms of our shareholders' agreement, we need to value our assets externally at least annually, so once a year. And it actually goes further than that because our auditors demand that in any event. So at the time of concluding our annual audit, our annual results, the assets need to be audited and valued at that point in time. So that process has become, very detailed. I mean, not only are the valuers involved, but the audit profession to a large degree has got very granular in getting involved in mitigating any risk and so on in this regard. Aside from that, every time we bring in a new shareholder into the business, we also undertake a valuation of the assets. So important to us that when we admit a new investor, they come in at a fair market price. So we recalculate the NAV of the business. Obviously, we're not listed, so we don't have a listed share price that's trading at this point in time. It's a private company. So in that respect, every time we admit a new investor, there's a valuation that takes place then. And of course, the board, if we feel that as management or as the board of the company that there's been a significant movement in a country or in a particular asset, we may well undertake valuations on an ad hoc basis at any point in time.
We've got two questions from Louis. Have you had any repatriation issues?
Yeah, so I think, and I can see the second part of that as well in terms of gearing. So from a repatriation issue, yes, we have. We have had repatriation issues of getting capital out of a country in Nigeria specifically, and that's something that we've had to manage. Essentially, the reality is that we were actually receiving some income in Nigeria in local currency, and the naira there. Obviously, Nigeria is a much smaller part of our business, but nonetheless, what we've done there is effectively have a discussion with our key anchor tenants, and a lot of them have agreed to actually pay us in physical dollars. So that then, once you have dollars, then you have dollars, so to speak. So you're able to expatriate those without problem, and that's what we've done. So we've managed to solve that problem to a large extent. Is it completely solved? I mean, the answer is no. But I think we are working on a few strategies to expatriate some of the local held naira, as it's called in Nigeria. The rest of the countries, obviously, we have the majority of our assets in Ghana. No issues there at all. We haven't had any problems there, and Zambia, no issues either. So that's all been good. So it really is quite a limited issue that we're dealing with in Nigeria at this point in time. From a gearing perspective, yes, we do gear the assets in country. So they need to be geared in country in order to have the suitable interest, from a tax perspective, and interest offset, interest expense. So that does happen in country. And obviously, to the extent we're generating income in country, like the naira example, I mean, one can effectively have your debt in local currency, and to the extent you ever had trapped issues or repatriation issues, you could simply just settle your debt. So there are ways of dealing with these things, but yes, we do gear in country, really, from a tax perspective.
I think this person might know more in Africa than me, but just a general question on trend of office leases as these blue chips leases run down. Do they generally renew or take up new premises, given that they may require additional capacity at the end?
Yeah, look, obviously those negotiations need to happen as and when those leases get closer to maturing. I mean, we're quite proactive in this regard, obviously, but our experience is that these renew. So it's a case of sitting down with the tenants, making sure that the building is still fit for use in terms of what they require. Do they require additional space, less space, whatever the case is? I mean, typically it's a growth story for many of these blue chips, and often they require slightly more space. So, but to date, I mean, we've had a number of renewals over the past year, and our retention rates on leases and renewing those leases has been upwards of in excess of 90%. So the bulk of those do renew, and they renew on favorable terms typically. So, you know, we're talking about large corporates here, typically large international blue chips. You know, so I think from a negotiation perspective, as long as the building is fit for use, and you've you know, we operate top tier assets here anyway. So, you know, our competition is somewhat limited as well. But the reality is, as long as the building is fit for use and they're happy with the space, and you come to the party, there's often less discussion around pricing of the lease and so on. So it is quite a good position to be in.
And just from my side, just to add on, maybe can you provide some color on that renewal activity? What's the kind of, you know, new terms? Are they big reversions? Is it kind of exiting at market? You know, is there upside? Maybe just run us through some activity there.
Yeah. So, I mean, if I take one example, I mean, we have the Accra Financial Center, which is a prime office tower in Accra. We had the African Development Bank, which is one of our large tenants. Now, they had a long historical lease on that building with a significant escalation rate that had actually run up well above market. So when we acquired the assets, we acquired that on the basis of market rentals. So we actually acquired that on a significant discount to what the income earning profile of the building was at that point in time. And you know, their lease was coming up for maturity. They effectively did a deal with ourselves where we reverted their lease not back to market, but it was somewhere between market and where they were paying. So still a healthy premium to, or healthy rate above market. But nonetheless, they were happy with that and extended their lease for a further 5 years. So that's typical of what we deal with. You know, it's about trying to, you know, none of these big corporates necessarily want to move, and you know, to the extent that we're running prime real estate, that they often are happy to stay and you know, as long as they feel like they're getting a decent deal.
I think there's a question from Corps. What sort of capital and rental growth can be achieved across property investments?
Yeah, so from a rental growth perspective, obviously, if we look at the escalation rates that are attributable to a lot of the assets at this point in time, we're averaging around about 3% escalation. So that's you know, annualized income growth of around 3%. In certain parts of the continent, it differs, right? So I'd say in West Africa, you often find there's a bit more octane, and we may get closer to 4. In East Africa, it may be closer to 2. But still, you know, both of those are healthy premiums above, or healthy rates above where inflation in dollars is currently. And you know, clearly it's a very different situation to if one had a local currency lease, as an example. So in dollars, around about 3% is more or less where we are. So that's income growth. From a capital perspective, obviously we pay out our cash flow, right? So our distributions, I've called it 5 to 8% as a target, are paid out on a semi-annual basis. And I think from a capital perspective, you know, we target an IRR of between 13 and 16%. So if one has to include your 5 to 8, the balance is obviously capital growth.
I've got a question from Nessie. Your fact sheets indicate a target 13 to 18% IRR in dollars. Has this moved up since inception of the company? Is this hurdle rate still applicable given the risks in Africa? Are there any opportunities you have walked away from that met hurdle rate but haven't met other criteria?
Hi Nessie. I think obviously our targeted returns between 13 and 16%. So 18 maybe on a gross basis, but net we look at 13 to 16%. In our view, you know, if you look at private equity investing, not just real estate investing, but private equity investing generally, you know, there's long been a notion of one needs to tick the box and either provide a 20 or 25%, you know, return given the risk, etc. I mean, we don't believe that's possible. We don't believe that's sustainable, really. If one looks at how private equity generally has disappointed over the last decade or so, that's been quite visible to everyone. So I think one needs to have a realistic view on this and look at something that's sustainable and that one can generate year on year delivery of. And I think 13 to 16 we believe as an IRR is achievable. I think distributions are between 5 and 8%, where we have a yield on our portfolio of an average of around 9 is very doable. Hopefully we can outperform that. But I mean, has this moved up since the inception? No, it hasn't moved up. I mean, we've left that target intact. The reality is we've been through a year and a half now of COVID. Have we had growth through that period? We actually have, but I think we're one of the few, and I think, it's not, we've managed to have 99% of our billings collected. That's quite a statistic, I think. Now, I think the fact that we've had some growth, but I think to expect significant growth through this last year and a half would have probably been a bit too much. Have we walked away from opportunities? I can't tell you how many opportunities we've walked away from. I mean, it's been a huge amount, right? So we see a number of deals. I mean, we have opportunities coming across our desk every day almost. A large chunk of those simply go in the bin. We're not prepared to even contemplate those. And then, to some of those that we do spend a bit more time on, the governance needs to be right, the returns need to be right, the partners need to be right. We're not just going to hop into bed with anyone here. So it's a very it's a very well thought out, a very considered process that we go through, in terms of making our acquisitions, and we're not going to have a knee-jerk reaction and just close a transaction. So have we turned away a number of deals? I mean, we do that all the time. Governance is a major issue, and we're quite careful on that front.
Maybe if I can just ask another question also linked to this with regards to transaction activity. It seems like the deals are coming to you, because I was actually going to ask, how do you actually source deals, given the investable universe being this big? Is it mostly, coming your way? And who are these sellers? Are they private equity exits? Is it owner occupiers? Is it sell and leasebacks? Can you maybe just give us some color on that?
Yeah, sure, Nazim. I mean, at the end of the day, I mean, Africa is a very large place, but it's also a surprisingly small place. So if one looks at sort of prime assets in prime locations, it's not a huge market actually. So it's very big geographically, and all these different countries have different nuances and different ways of doing business and different risks attributable with them. But at the end of the day, in terms of the prime asset landlords, the real estate holders of prime assets, it's not as big. And the reality is we've been involved in the space for a long time. People know us, we know them. And invariably it's a direct call, that comes through. These other opportunities that tend to find their way across our desks that we end up turning away are often ones that people we don't know and maybe don't want to know, So we see a lot of that, but yeah, I mean, we often have a direct relationship with a number of these sort of blue chip holders of assets.
And we've got a question from Paulo. Are you not worried about having a listed price on IPOing if you look at other peers, such as Grit? Maybe it's unfair to compare, trade at a massive discount to NAV. Do you think the market will reflect a fair price to NAV?
Yeah, I think a couple of comments on that. And look, I don't necessarily want to compare to Grit. I think our storyline is very different. I think our investment thesis and the way we've built our business is very different. They are, I mean, I've heard a lot of people say that they come across as being very opportunistic. They're into a whole bunch of different sectors. It's almost if they see a deal, they'll close a deal. We've been exactly the opposite, right? I mean, it's a very considered approach. It's a very focused approach. It's commercial real estate only, office and retail only. We're not going to get into all these other sectors, hospitality, et cetera, and very focused on the nodes. So it's the key capital cities that we're involved in, that's it, right? You're not going to find us in secondary cities, whereas Grit does exactly the opposite, right? They're all over the place. So from that perspective, a very different proposition. In terms of the discounts, I mean, it's hard to say. I mean, if we had been listed now, would we have potentially been trading at a discount? I mean, it's possible. It's hard to say that we wouldn't have. I think there's a time and a place to list, and again, we've been quite considered in how we're tackling this, and the type of the investors. I mean, if you look at our shareholder base, it's absolutely blue chip in terms of international savings industry. The big names out there. I mean, it's big sovereign wealth, big pension funds. It's stable money. It's long-term money that's bought into us, right? So it's not necessarily money that's going to flip in and out and potentially drive accelerate a discount. And secondly, in addition to that, if we look at the underlying real estate, we have consistently been very, to the extent we could and where it's been possible, we've been very conservative about how this portfolio of ours is valued. Obviously, we don't value it; it's independently valued. But the whole rhetoric around our DNA is one of we're not gunfighters here. We're not trying to be aggressive in terms of driving returns, driving value at the end of the day. It's a bit more of a conservative return. I think that's stood us in good stead. So I mean, Grit as an example, they publish their yields and their discount rates attributable to the value of their assets. I can tell you now, the yields and the discount rates that they value their portfolio at is very different to where ours is valued. And we have different values perhaps, or whatever. I don't know what the answer is, or maybe management are pushing numbers a bit harder perhaps, or not. But the pure fact of the matter is there's a difference in that, and I think that may lead potentially in terms of the actual just the simple value of the assets may be part of the reason behind a discount that's being in play.
So maybe one final question from my side. We've spoken a lot about the office portfolio, but could you maybe give us an update on some of your large retail assets with regards to current vacancies? I know some of the other SA funds that have assets in Africa or have significant vacancies. Maybe you can just run us through some of the large assets, and obviously there's been some major or national retailers retreating from Africa as well. Is there enough tenant demand to pick up that slack?
Yeah,
it's happening in your portfolio.
That's a good question. That's a very good question. I think if we look at the retail space, I mean, first and foremost, just a bit of history here. Obviously, if we look at some of the other South African property companies that own retail space throughout the continent, we had the fortunate opportunity, I guess, when we came in the last sort of 2 to 3 years in terms of the real acquisitions we made, we had the benefit of hindsight. So we could look around the continent and see, okay, this asset's performing, or that asset's performing, or that asset's not performing, and effectively cherry pick, for lack of a better word, the assets that we were happy to take. So we've actually managed to cherry pick arguably some of the best retail space across the continent at this point in time. There are numerous examples of other assets across the continent that are not working, but the assets that we have are real strong performers. So if we look at vacancies and so on, I mean, we've had a vacancy at both Junction Mall and Achimota, and those were on the back of Edcon. And obviously we're aware of Jet moving out, etc. And that wasn't just in SA, it impacted us obviously as well. But we've replaced those spaces now with LC Waikiki. So it's a Turkish brand that's come in, good operators, and they've taken up that space. So yes, we've had instances where we've had to manage vacancies, but do we have a vacancy problem in these assets? The answer is no, absolutely not. So we are seeing the likes of Carrefour as an example, a big French grocer, talking to us about the possibility of taking up space, looking, could we potentially expand one of our malls? So we're looking at opportunity to expand Junction Mall at this point in time, add an extra box, a wing effectively, or a dumbbell as we call it, onto the end of one of those. they're potential candidates for that. There's some other, if we look at some of the local Ghanaian retailers, there's been strong growth in terms of some of the local market, actually, interestingly enough, So I don't think we're particularly concerned about vacancy at this point in time in the retail space.
Thank you so
I think
much.
maybe, Nazim, just one final comment. Sorry, and obviously I'm UK based. I mean, my the head office of the business, so to speak, is largely in the UK. Obviously, we have a large amount of people in SA and then people in country. But part of what I'm starting to do, aside from obviously driving the stakeholder interaction, which I do, is driving, getting UK and European brands and those from the Middle East potentially, but it's more UK European brands interested in Africa. And the reality is we have a portfolio which has now got to the size where it's large enough to offer them, space in 5 or 6 malls or whatever the case is, So as opposed to coming into just one asset or whatever the case is. So there's a bit of scale we can offer them, and we are pursuing an international tenant strategy. I think the reality is we've worked out that we can't rely on the South African tenant base going forward. We need to increasingly start making sure that we have that diversity of sourcing tenants from the international markets as well.
Finding the mute button. Thank you so much, Thomas. I found this very informative. But it seems like we've come to the end and there's no more questions on WhatsApp or on the chat room. So that's it from our side. Maybe just some concluding remarks before we close the meeting.
I think just from my side, just to thank you for the time, first of all. I think, from Lango's perspective, we've built a business now over the last few years, which has got, as I said, really credible stakeholders. It's one of the few well-governed businesses that can attract international capital, into the space. And what we're aiming to do is deliver sustainable returns over time, and hopefully ultimately catalyze the real estate sector. That's what we're all about. Hopefully trying to bring some liquidity to and growth to the real estate asset class, so to speak, on the continent. And so hopefully doing our bit in that regard. So thanks for your time.
Thank you, and thank you to all participants for joining in. We'll see you tomorrow morning. Thanks again, Thomas.
Thank you.